Hey, what's up, stock compounders? Brad here. So, I just had a look at Seth Klarman's annual letter to his investors. Now, Seth Klarman is a legendary value investor, okay? And in that letter, he mentioned that there was one of the biggest US pension funds is now using leverage to try to meet its obligations, okay? Now, I think the pension fund he was referring to is CalPERS. Okay. California, let's look at what it is. California Public Employees Retirement System. Okay. Now, CalPERS distributes benefits to about 1.9 million people in California. These are public employees, retirees, and families of those public employees and retirees. Now, so every year, CalPERS pays out retirement benefits and health benefits. Currently, they are significantly underfunded. All right, right here, their $395 billion in assets represent just 71% of what it needs to pay these retirement and health benefits to those 1.9 million members. So, what Seth Klarman was trying to point out here is that you have this pension fund that should be quite conservative in its strategy for investing its assets. But you have a case here where because of the low return environment we're in, the low interest rate environment, you've got this huge pension fund that has decided to use $80 billion of leverage to try to increase its returns. All right. That's terrifying. Now, if you are one of these public employees or these public retirees, and you're counting on this money to, for your retirement or for your health payments, this is a terrifying prospect. In my opinion, I mean, you're going to need to come up with a plan B for how you're going to pay for your retirement, because this strikes me as a very risky move from CalPERS, and it's kind of a sign of the times where these pension funds and large institutions, they have kind of a target return goal, right? In this case, it's 7% annual returns. But I got to tell you guys that the market doesn't care what your return goals are. All right. And if the only way to try to keep up with, growing the assets in order to meet these obligations to public employees and retirees, if your only strategy for trying to have grow your assets at a fast enough rate to meet those obligations is to use leverage, guys, that is a huge red flag. That makes me very nervous. Makes me very nervous. So, like I said, if you're depending on this, on CalPERS, I mean, you're going to have to come up with another way, I think, because I think this is very likely to go south. Um, Monish Pabrai, one of his 10 commandments of investment management, thou shalt not use leverage. Okay? Because when you use leverage, I mean, you can juice your returns, right? You can make more on the same asset base when you're using leverage. Problem is, you can also lose more than what you would use if you were just using your own money, your own assets. And especially at this time in the market, based on what's happening with the pandemic, what's happening with jobs and unemployment rates. I mean, it is a very scary time to me to be using leverage to try to get a little bit more out of your investment returns. I think a few years ago, CalPERS had an investment target of 7.5%, and they lowered that to 7% because the investment environment dictated that they do that. So I'm surprised that they're not just saying, okay, well, we have to lower our target again because of the investment environment we're in, and states are going to have to chip in here to try to you know close that gap between the assets that CalPERS currently has and what it's going to need to pay those future beneficiaries and current beneficiaries. So it's a mess, guys. I'm very curious. I'm watching curiously to see how this unfolds. Um, but I am very pessimistic about this approach of using leverage to try to close that gap for CalPERS. Um, and Seth Klarman was really pointing to it as a sign of the times that we're in this lower return environment, and we can either accept that, um, or we can resort to using strategies where we're taking on more risk to achieve the same returns that we have been able to achieve in the past. And of course, taking on more risk to achieve higher returns works until it doesn't. It works when things are going well, when the market is going up, but it has the opposite effect. It magnifies losses when things don't go as planned. So I'm quite concerned for public employees in California based on what CalPERS is doing here, the approach that they're taking to close that gap. So I just wanted to point that out. I'm really surprised that whoever made this decision, the person who's in charge of managing the assets of CalPERS, I'm really surprised they're allowed to be doing this. It's quite concerning. So yeah, I think that's all I have to say about this. Let me know if you're familiar with this story, if you're familiar with what's unfolding here for CalPERS, and what your opinion is of this. What should CalPERS be doing instead of doing what they're doing now, which is using leverage to make sure that they can pay out all of those obligations that they've said that they were going to pay out, that they signed up for. So let me know what you think in the comments. And obviously there's another way to increase your returns that us value investors are familiar with, which is that you don't necessarily have to take on more risk in order to get higher returns. You have to find mispricings in the market. And I'm sure that's a lot harder for an institution that's as large as CalPERS. I think they have like $400 billion of assets right now, which I don't think is too far off from what Berkshire Hathaway manages. But you don't have to take more risk necessarily in order to get higher returns. You just have to find things that are at a discount. Of course, Seth Klarman, who brought this to my attention, is well known for his book, Margin of Safety, buying assets for significantly below what they're worth. So, it's a scary situation with CalPERS. Just wanted to bring that to your guys' attention and curious to hear your thoughts on it. So with that, I will see you guys in the next video. Take care.